Welcome everyone. Welcome to this episode of the Weekly Market Wrap. I have with me Mr. Pankaj Pandey. And what a week this has been. Of course, geopolitical tensions have been high over the past week and markets have been shaky. As of now, the tensions are still high. So, what is the outlook on the markets?
Yeah, hi, good evening, Vishu. Yes, I think the geopolitical tensions have taken center stage, and which is why the risk on sentiment in the market is what is being observed. And in this process, we have seen markets sort of shaving off nearly 2.5% this week. Sum total, it has declined about 5 odd percent. We've seen nearly 18 to 20% kind of a spike in crude oil prices, and that has sort of created fear in the rupee also. So rupee also touched a new low. The volatility has again sharply gone up. We've seen a 40% spike there. But in this mayhem, overall, some of the defensive counters, say for example, pharma has sort of done well, defense is doing well. PSUs have relatively done well, whereas we are seeing profit taking was clearly visible in some of the PSU banks, oil and gas, and autos. And reality sort of continues to sort of remain on the sidelines. Overall sense is that this till the time this volatility persists, which is what we would expect for some period of time. I think if the market are holding at 24,300 kind of a level, then possibly towards 25,000 or 25,200 is what we can think of in the coming weeks. Otherwise, on the support side, probably even levels below 24,000 is possible. So 23,900 is what we would look at. But one thing to sort of highlight is that since 2014, Indian markets have seen major corrective phases. And in a big corrective phase, typically the correction phase lasts somewhere about 18 to 20 odd months. Currently, we are in the 18 odd month. And overall sense is that whenever this consolidation gets over, typically the recovery also sort of happens faster. And also from the perspective that overall market breadth also has again turned sort of bearish. So earlier we had seen a recovery in the market breadth. Now again market breadth when we sort of look at is sort of the Nifty 500 stocks, it's come down to closer to levels like 30. And I think key monitorable again would be crude oil prices. We've seen crude oil prices jumping up to 84, $85, and there is a fear that if this sort of correction continues, probably market might also sort of languish or may witness an incremental correction. Nothing much we can do about this because this is happening somewhere where we don't have a control of. But I think overall sense is that when we sort of see events like this, a market usually has a tendency to sort of correct sharply, and then over a period of time it does recover. So we are hoping that overall this looks like a one-sided war and hopefully should not last very long.
Absolutely. Uh, what has been the stance of FIIs amidst all of this?
So again, two parts. So for example, everything was going good because in the early part of the Feb, we had seen the the US-India trade deal largely being announced. So Feb was a pretty good month, but if I look at for the month of March, we have seen FPI selling about 16,000 odd crores. Now, while yes, nothing we can do about given the sell-off we are seeing not only in our markets but global markets as well. But if I look at for the month of Feb when the war was not there, so when we look at the sectoral biases, clearly what is coming out is that the FPI's sectoral biases towards capital goods, power and metal is definitely there. So these are the sectors which are favorites for them. And so for the month of Feb, they bought nearly about 22,500 odd crores. And this is despite the fact that they have sold somewhere about 17,000 odd crores in technology. And technology continues to sort of struggle. We've already seen most of the stocks sort of making lows. So if I strip out technology, effectively they've bought nearly 40,000 odd crores, which is one of the highest buying which we have seen in the recent months. And clearly, capital goods is finding favor. So sectorally, they have bought about 12,000 odd crores. Next comes is BFSI, about 8,000 odd crores. And then we have seen metals somewhere about 5.5 lakh crores and power also closer to 5 lakh, 4.5 thousand crores. So clearly, there is a bias towards some of these sectors like, say, metals, capital goods, and power. And overall sense is that when this geopolitical volatility sort of settles down, we would see some of these sectors again finding favor. So that is where we are sort of looking at. And I think any kind of an incremental weakness in some of these counters will be an opportunity to buy.
Right. So I think the biggest question right now in everybody's mind is the war that's going on. Given such a scenario, what should be the strategy for a retail investor be?
So, Vishu, when we sort of look at the entire CY25 calendar year 2025, we were entangled with a lot of these geopolitical tensions plus tariff-related uncertainty. Now, even in this sort of continued in the early part of CY26 as well. And things were started to sort of looking better with the announcement of the India-US trade deal, plus the overall corporate earnings cycle last quarter was pretty decent. And which is why we have seen FPI change of bias and all of it. But now we are again caught in a geopolitical event, so US, Iran, Israel conflict. So in this conflict, what we have clearly seen is market sort of losing 5% of the overall gains. So we have seen crude oil prices spiking 20 odd percent. And overall sense is that when we look at these kinds of events, historically we have something like say Russia-Ukraine conflict. That point of time, we had seen market a correction of about say 11 odd weeks. And what has happened was that in the subsequent, say, 3 to 6 months, when the market had sort of made the lows, in the subsequent 3 and 6 months, we have seen markets sort of doing very well from that perspective. So delivering double-digit kind of gain. So market typically recoups most of these knee-jerk adverse events and typically does well. And that is what we are sort of looking at this point in time. So there are a number of events which we have penciled in our report. But our sense is that once this dust settles around this event, markets in the next 3 to 6 months ideally should recoup most of these losses. But we are sitting at 5% loss, and I don't rule out a possibility where crude oil prices can't spike. So I think that is where the challenge lies. It is difficult to predict how long this is going to last, and even the crude oil prices, which are at 84, $85, how long they are going to stay at these levels or even probably higher. So that is where the challenge lies. But overall sense is that once this dust settles down, things are expected to be okay for the markets. Now, again, from a investor perspective, like I said, it's a waiting period, and overall sense is that some of the sectors where the FII bias is clearly sort of positive, or overall where the earning growth has been good. So these are the sectors to sort of look at from an opportunity perspective. If I have to name some of the sectors, that will be banks plus capital goods plus auto ancillaries, some consumption names on the discretionary side, some bit on the real estate. So I think some of the sectors or segments have been impacted, and these are the ones we would prefer.
Right. Uh, uh, Getting a little deeper into the sectoral impact, you mentioned, I'll take them off one by one. I think let's start with autos.
So, Vishu, autos overall, see, obviously, in every sector, you will have a primary impact and you have a second level of impact. So, second level of impact could be that if the crude oil prices goes up, the petrol and diesel prices are also will go up, and it will have its own share of impact. But if I look at the primary impact, so it will be on tire companies because they use a lot of crude derivatives. Say, for example, carbon black, synthetic rubber. So these are the primary raw materials of there. So obviously for them, margin pressure would be there. Another impact could be companies which are sort of exporting. So our sense is that the freight cost will go up. So you will have companies like Bajaj Auto where the export revenue share is somewhere about 33 odd percent, or you would have companies like Bharat Forge, 54% of the revenues coming, standalone revenues coming from exports, or Balkrishna Industries about 70 odd percent coming from export sales, or something like Sansera about 24, 25 odd percent. So these are the companies which will get impacted. In OEMs, we will prefer Maruti and M&M because of good set of numbers. Or in ancillaries, we'll prefer something like Uno Minda and Lumax Auto. So every sector will have some impact, and this is what we sense for auto.
Right. How about capital goods?
So on the capital goods, when you look at, we have clearly seen L&T few nifty stocks which has witnessed a correction of about 10 odd percent. Now the reason is that a lot of order inflows for some of these companies that comes from these key GCC countries like say Saudi Arabia, UAE, and Kuwait. So for L&T, 37% of the order backlog is from the Middle East. KEC International about 45 odd percent. We have Kalpataru somewhere about 37 odd percent. So these companies have definitely seen an impact. And not only in terms of order inflows, even the execution also can get impacted. But our sense is that when the dust sort of settles down, it's not that the order is coming from Iran, the order is coming from some of these countries. So our sense is that whenever the dust settles down, most of these companies are good goods again. Will Some pockets will get impacted, and then I think they'll beside that some exporters also might see some impact. Something like say LG equipment, NRB bearings, or Aeroflex.
Right. Next up, of course, defense has been standing tall amidst all the volatility.
So yes, I think any kind of a geopolitical disruption is positive news for defense because what comes out is that a lot of new weapon technologies get tested and a lot of shortcomings get highlighted, and that is where we see a lot more fresh funds or incremental sort of technologies or overall gaps are identified and sort of filled. Now, from an impact perspective, it is very much possible that this segment might get impacted negatively because of the supply chain risks. We need to understand that US and Israel both are key suppliers for some of the critical systems and components. So it can get delayed, or there could be a challenge there. But like I said, it also sort of highlights the kind of an opportunity or the readiness the defense needs to keep. So from that perspective, right from electronic systems, missiles, combat drones, or a lot of other munitions, so might see a good amount of jump overall in the next few years. So defense, I've been highlighting that should be one of the few sectors where things are expected to remain quite robust. So any kind of a major weakness there should be an opportunity to buy. So, in terms of stocks, what we prefer is Bharat Electronics, which is already making 52-week high, or Astra Microwave is what we would like. So overall, defense is something which we would expect to sort of continue to remain in limelight for quite some time.
Right. Next up, we have paints, which have been impacted, I think, quite a bit because of the crude as an input.
So, Vishu, if I look at some of the consumer discretionary categories, one of them is obviously paints. Now, in paints, if we go by the example of Russia-Ukraine war, that point of time, the crude had jumped to about 110, $112 per barrel. And what has happened was that since the some of the raw material prices for the paint companies or inputs had gone up, we've seen companies like Asian Paints or some of the companies had witnessed a gross margin contraction of about 400 bips because the impact gets visible with a quarter, with a lag of a quarter. And which is why overall sense is that even this time also, if the crude oil prices remain at elevated levels for a bit of a longer period of time, so that is where probably we might see margin compression being there. But overall sense is that the companies will be able to sort of take price with a certain lag. Don't see a structural decline in the margins. And what we like is that we have already seen the Asian Paint stock sort of correcting more than 20 odd percent. So it's trading at an attractive valuation of 38 times on a forward basis. I think same is the case with hotels also because hotels, the overall demand is good. But what can happen is that we are already seeing some cancellation of flights. And as a result of that, we are seeing room cancellations as well. Typically, for foreign tourist arrivals, this is not a peak season, but it could have some impact. So it is possible that the RevPAR growth might see an impact of 2 to 3 odd percent. And so that is where things will become challenging. But we also need to sort of understand that a lot of domestic events are sort of there. We already have a cricket season sort of going on in terms of World Cup and also in terms of the IPL season expected to sort of come back. So that might sort of provide some relief, but any kind of a weakness is again a good opportunity to buy to some of these counters like say Indian hotels ITC hotels or chalet hotels.
Right. How about building materials?
So if I look at again from the perspective that we have already seen some of the companies like say Kajaria or Somani or other players sounding out concerns that the gas prices have gone up because some of these building materials, especially companies which are operating in the tiles domain, they use a lot of gas to sort of produce the product. And in fact, their sensitivity is quite high from the perspective of gas prices. So any 5% kind of an increase in power and fuel cost has an impact of 5 to 10 odd percent in their EBITDA. And that is for Kajaria and Sumani, which is the companies what we track. Now, even the concern is that these companies might have to sort of curtail production because not they may not really be getting the enough supplies. So it is very much possible that there could be impact on the both margins plus potential volume. So which is why we are seeing some of these companies under stress. Wouldn't suggest to sort of do bottom fishing currently because their sensitivity is a lot more higher compared to other sectors. And even for a big sector like oil and gas, so overall sense is that when you look at the Strait of Hormuz, it's extremely important for us because nearly 40 to 50 odd percent of our crude oil imports passes through that. 55% of the LNG comes from there, and 80 to 85% of the LPG imports also sort of transit happens through that. So obviously, it is quite sensitive for us because for us, the oil import bill is in excess of 100 odd billion dollars, and I think we have already seen 20% kind of an increase. Now, good part is that the US has given us waiver in terms of acquiring crude from other sources, including from Russia. So that's a sort of a positive sign that might sort of protect some of the refining companies to some extent, and even if the refining margins are expected to go up, which is what we are sort of sensing. So it may not be an entirely lost game, but things are going to remain volatile for companies in the oil and gas domain and the direct or companies which have got higher sensitivity coming from oil or either from gas.
Right. Associated sectors, related sectors are metal and cement. What's your thought on them?
So again, different kind of impact. For example, in case of metals, overall no major direct impact. But what we are seeing is that Middle East is a decent size producer of, say, aluminium. Now, aluminium they overall contribute about 8 odd percent, and we have already seen some disruption there, and which is why the aluminum prices have gone up. And which is why we see that companies like Hindalco and Alcoa and others are sort of rallying. So, not to say that we have not been liking these companies, but these companies have already sort of done well, and because the aluminum prices and a lot of other commodity prices or non-ferrous prices were on the higher side. So this is not a space we would want to chase. Probably, I think what can be looked at is the ferrous space. Ferrous space looks relatively better to us because we can't really play this volatility of prices going up in a shorter span of time and then trying to sort of put a trade there. So what we prefer is Tata Steel and Jindal Stainless. Now, cement, though it is a local commodity, but probably can get impacted because what we import is the pet coke. Pet coke is one of their power and fuel cost, which is for the cement companies. Now, we have already seen pet coke prices jumping up about 10, 11 odd percent to about $135 per ton. So obviously, it will have some impact on the cement companies because they have already taken a price hike. For the price hike could be a sort of a challenge. So it is possible that some impact might be there, which is why we are seeing some weakness in the cement prices. But our sense is that you do have alternatives there. And petcoke, by the way, a lot of what we source is coming from State of Hormuz. So obviously, cement companies will be impacted. And which is why any kind of a weakness should be an opportunity to buy because most of the other parameters are driven by domestic variables. So I think in some commodities, overall, one needs to sort of play tactfully. Not everything is a buy in the commodity side, especially both cement and steel.
Absolutely. And as I understand, given the volatility, we do not have a hidden gem this week.
So Vishu, what we've come out with is a list of stocks because we have seen that in this knee-jerk reaction in the market because of the geopolitical developments, a lot of stocks have corrected, and where we feel that probably while yes they have corrected, but the overall impact may not be that high from a P&L perspective. So, for example, L&T, while yes, domestic demand is pretty good, there's some bit of an export orders which are there, which might get delayed. But we've seen a very sharp decline, so which is why I feel that L&T is a buy at current levels with a target price of 5030, so roughly 30% kind of an upside. LD equipment is again an exporter, might get impacted because of a higher freight cost. So that is also a stock which is looking attractive to us, does not have too much of an exposure to the Middle East. Now even banks have witnessed a good amount of profit take. City Union Bank has witnessed a good amount of profit take, so that looks good to us. So there we have a target price of 320. We are in general bullish on the market. So one way to sort of play the entire market, whether it is large cap, mid cap, or small cap, is AMC stocks. So Nippon Asset Management Company is what we are recommending with a target price of 1020. So that looks attractive. I already spoke about hotels being an attractive opportunity. So Chalet Hotels has also seen a good amount of price correction. So there we have a target price of 1055. NRB bearing also from that perspective. So there we have an upside of about 37 odd percent. I already spoke about Asian Paints getting impacted. So the stock is down about 22 odd percent. And valuations are attractive. And you would not want to believe that the crude link derivative or input prices are going to remain at elevated levels. So it's a good opportunity to buy. And textile stocks also, because sentimentally some of these textile stocks have also taken a beating. So Indocount again has lost some of the ground. So that is another stock what we like with a target price of 400. So instead of giving one single stock, I think market has thrown opportunity in number of sub pockets or sub segments, and which is why one stock I forgot to mention was Star Cement. So it's a cement stock. Again, has seen a good amount of decline there. We have a target price of 300. So I think a lot of stocks will come to quite a level as well. That these are the stocks one should look at over the next course of time from a buying perspective.
Absolutely. Well, that was it for this time. Thank you so much for your time and insights, and thank you so much everyone for watching. This has been very insightful. But if you have any questions, please do put them in the comments, and we'll try to get back to you. Thank you.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.